All right, so you see a professional stock report, and it's just filled with charts, numbers, and jargon. What is it actually telling you? Well, today we're going to tear one apart. We are decoding a full technical analysis report on AutoZone, ticker AZO, to figure out what the pros are really looking at. Let's jump right in. This is the big one, right? This is the question that's on everyone's mind. Should you be buying this stock? It's why these reports even exist. But, as you're about to see, the data rarely, if ever, gives you a simple yes or no. So, this is our source material, and it's a beast. This thing uses over 120 different technical indicators to come to its conclusions. That is a ton of data. And right there in the summary, it tells us the situation is complicated. So our job here is to unpack that complexity piece by piece. And this right here is the heart of the story. You got to think of it like a massive tug of war. On one side of the rope, you've got all these signals that are screaming, hey, the price is going up, things look good for now. But on the other side, you've got these bigger, longer-term warning signs pulling back. So let's look at the evidence for each side, starting with the bulls. Okay, first up, we're joining Team Bull. We're going to explore all the data points that suggest AutoZone stock has some serious positive energy behind it right now. What are the green flags that are getting traders excited? Before we dive in, let's just quickly get on the same page with a key term you're going to hear a lot, the moving average. It's one of the most basic tools in the toolbox. All it does is smooth out the day-to-day price bounces to show you the real underlying trend. And the rule of thumb is simple. If the current price is trading above its recent average, that's usually a sign of strength. And boom, here's a perfect example. The report points out that AutoZone's price is currently just under $3,900, but look at this. It's trading way above its average price over the last 5 days, 10 days, and even 20 days. For an analyst, that's a classic check mark in the bullish column. It shows clear upward momentum in the short term. But it's not just about where the price is, it's about the energy behind the move, the momentum. And what's really interesting here is that even though the overall momentum score is still technically bearish, the report says it's getting better. Plus, a key indicator called the MACD histogram, which kind of measures the acceleration of a trend, has turned positive. It's like the trend is starting to press the gas pedal. The case for the bulls gets even better when you look at the trading volume. See, the report notes positive volume trends, which suggests big investors are accumulating or buying shares. That's what you want to see. A price rise on low volume is suspicious, but a price rise on strong volume, that's like a vote of confidence. On top of that, the price is pushing up against what's called the upper Bollinger Band, another sign of strong buying pressure. So, to wrap up the bull argument real quick, we've got 4 key things going for us. Momentum is picking up steam, the trading volume confirms the price rise, the price is staying above key support levels, and it's pushing the upper limits of its recent range. So far, so good for the bulls, right? But now, we have to flip the coin. Of course, that's only half the story. It's not all sunshine and rainbows. Now we have to put on our skeptic's hat and look at the evidence for the bears. All the data points that are flashing yellow or even red, telling us to be careful. And this slide, wow, this lays the entire conflict bare. It's so simple, but so powerful. Yeah, all those short-term averages looked fantastic. But when you zoom out, the longer-term trend is still pointing down. This is the core tension. We have a nice little rally happening inside of a much bigger and still bearish trend. This is a classic trap for traders who aren't looking at the whole picture. And that leads us to another really important piece of jargon, overbought. Think of it like a rubber band. You can stretch it and stretch it and stretch it, but at some point, it's probably going to snap back. When a stock is overbought, it means the price has shot up so far, so fast, that it might be due for a cool down or even a drop. And here's the smoking gun, pulled right from the report's data. An indicator called the stochastic RSI is at a reading of 100. That is the absolute maximum reading possible. You literally cannot get more overbought than that. And the analyst's own note is pretty blunt. Watch for pullback. This is a huge blinking warning sign for the bears. So here's the deal. Even with this nice recent rally, the price has basically run into a brick wall. It hasn't been able to break through some of those key longer-term averages, like the 50-day average you see here. This level is now acting as resistance. It's a price ceiling that the stock just can't seem to punch through. For the bulls to truly be in charge, the price has to conquer these levels. All right, let's recap the bear case. First, the stock is extremely overbought, which means the risk of a price drop is high. Second, other important momentum indicators are still negative. And third, the price is slammed right up against that major resistance level we just talked about. That's a pretty compelling argument for caution. Okay, so we've seen the bull case, we've seen the bear case. And honestly, they're both pretty convincing, and they're both backed up by the data. So how on earth does an analyst weigh these conflicting signals to come up with a final call? This is it, the moment of truth. After sifting through all of that conflicting evidence, where does the report actually land? In this tug of war between the bulls and the bears, who has the edge right now? First, the analyst draws the line in the sand on the downside. This number, just under 38.50, think of it as the floor. The report calls it the key support level. As long as the price stays above this level, the short-term bullish story is still in play. But if it breaks below this floor, the bears get a major victory. And on the flip side, we've got the ceiling. This is that resistance level we talked about, the big test for the bulls. If the price can find the strength to break through this level, that's a huge positive signal, and it would suggest this rally has a lot more room to run. These two numbers basically define the battlefield. And here it is, the final verdict. The official outlook is bullish, but only in the short term, with a price target right at that resistance ceiling of $39.42. Now here's the big however. The number one risk is those overbought signals we saw. For the medium to long term, the outlook shifts to just neutral. The takeaway is that while there might be a quick upward move, the bigger picture is way more uncertain. The key advice? Watch that 50-day moving average like a hawk. So what's the really big takeaway here? Technical analysis like this gives us a fascinating look at the market's mood, the psychology of traders, this whole story of bulls versus bears. But it's only one side of the coin. The crucial next question you always have to ask is this: does the company itself, its sales, its profits, its growth, actually support the story that the charts are telling? And that is a question for another day.